And we should be live. And we should be live on now multiple platforms using a new software.
Yeah. Ready for bourbon and taxes.
Ready for bourbon and taxes. Awesome. Let me log into Facebook and see if we got on to Facebook in the right spot.
Yeah, we are.
We are?
Yeah.
Nice. Look at that. Cool, man. Oh, we got this purple background here.
Yeah, I wonder if you could change that up.
You could definitely change it. I just don't know how. Oh, here we go. Overlay, background. Can we see like no background? Here, that works. That's better. Oh man, I don't want that. Here, how about that? Okay, that works. That's a little bit better. Whoa, man. Okay, anyway. We should also be live on YouTube, I believe. So
really?
Yeah, and Instagram. Oh yeah, this is cool. We got 3 people on YouTube watching us right now. You can hover over that little icon at the top and the viewer icon. You can see we got a few on Facebook and a few on YouTube. Well, thanks everyone for joining. Happy Tuesday evening. Welcome to another round of Taxes and Bourbon, or Bourbon and Taxes, depending on what you prioritize. I am drinking Four Roses tonight. Again, single barrel, working that bottle down. What are you still drinking? The Makers?
I'm still drinking the Makers Mark, which apparently isn't real bourbon, but it says it on the label. So,
all right, yeah. So, question to the audience, and type into the chat here because we can see all your chat. So, 2 questions. First, where are you listening from? Second question: is Maker's Mark real bourbon? Yes or no?
It says whiskey bourbon right on the top, right on the label.
Can you really be bourbon if you're whiskey bourbon? It's kind of like I don't know.
Gotta be honest, I don't know.
Huh? What is that? Yeah, I'm trying to think of other idioms or whatever those are called, but I'm coming up blank. So just let us know if you think whiskey is real bourbon, if Maker's Mark is real bourbon or not. But wow, we're done with tax season. Holy crap. That was a lot.
Really?
Happy to be out of that. The last 1.5 years, I know that if any of our clients are watching this right now, they're probably like, yeah, I get that. The last 1.5 years was tough, man. It was real tough to run it's tough on everybody, but really tough to run a tax business. We struggled with turnover, COVID turnover, which is I didn't really anticipate, and we couldn't hire replacements. So I had to get back in and prepare and review a bunch of tax returns, help the team out, which is fine. But I was shocked. I mean, normally when we put a job posting out, we get 100 applicants, and this year we put multiple job postings out and got a grand total, I think 4 applicants. They're starting to roll in now, so I'm hoping I think that fall recruiting season is going to be better. But man, it's a tough year, really tough year. I always struggle with capacity.
Well, it wasn't just us too. I got an email today from Gusto. I don't know if anybody's familiar with Gusto, the payroll company, and they seemed like they were suffering similar issues. So it's not just us.
Yeah. And I'm in a CPA firm group where a lot of CPAs kind of struggle with the same thing. So I know that it's not just us, and and I've actually heard a lot from prospective clients that want to switch to us, saying that their CPAs literally still haven't delivered their tax returns. I mean, we're past the deadline now. And I will say, even though our tax preparation this year was brutal, and if you were a client, you know what I mean. I think 50% of our clients they don't even know what I'm talking about right now. They're like, "What? The service was amazing," but the other 50% are like, "Yeah, that was a little rough, a little questionable." But I'll tell you what, we got all the returns done. I think by Thursday evening last week. Not that that's really anything to brag about, but there's multiple people that have reached out to us saying, "Yeah, we're still waiting on ours," and that is, I mean. I feel for the CPA community. It's It was a tough year. Tough year. Transactional business, tax preparation, very transactional, very tough to run. So give your CPAs a little bit of slack. It's been a really tough year and a half for CPA firms across the country. Talent has just disappeared. And I say that coming from, we run a virtual CPA firm, and we have a massive competitive advantage because we run a virtual CPA firm, because everybody wants to work virtual. But that competitive advantage kind of didn't help us out with the recruiting. So very interesting year. But what are we talking about today, Tom? What do you want? I have an idea, but I want to see if you have anything you want to talk about first.
Honestly, I don't have anything much to talk about. I thought I was just going to show up and hope you had the idea.
Show up and drink bourbon.
Yeah, I mean, look.
What if I didn't have an idea though?
Then I would have to think of something. But...
So my idea tonight is to talk about, partial asset dispositions. You want to do that?
Sure.
Okay. So partial asset dispositions, folks, probably the number one, I would say, overlooked tax deduction for real estate investors. And I want to talk to you about it tonight. And if you can really try to listen to what we're going to talk about and understand the basic logic of it, like what I want to do is set you up to be able to go and talk to your own CPA about this type of stuff. So a partial asset disposition, what is it, Tom? What's a partial asset disposition?
So basically, a partial asset disposition is disposing part of the asset that you have. No, okay. So break it down, right? So you have a building. The building has multiple components to it. We all know that already. Anybody's familiar with cost segregation studies. And, basically what's going to happen is over time, you're probably going to end up renovating part of the property and disposing of a specific asset. The biggest one, the biggest example we always go to is the roof. Eventually, you're gonna replace that roof, and you're gonna have a depreciation schedule. So the property, let's just say you have a residential property, that property is going to depreciate over 27 and a half years, including the roof. The thing is, when you replace the roof, if you don't do a partial asset disposition, you're still going to be depreciating that roof, that original roof, as part of the 27 and a half year property. So the partial asset disposition is it takes a value to that roof, and basically you're deducting that value of the remaining value of the roof that you disposed of in the year you disposed of that roof, and you're no longer just depreciating it over 27 and a half years, getting a little bit back each and every year.
Right. Right. So the whole idea is that if I rehab something and I rip components out of the property, then the components that I ripped out of the property should now be fully written off because they no longer exist. Right. So if I have carpet, let's say I buy a property and I do a cost segregation study. And $5,000 is allocated to the carpet. Well, if I replace the carpet and it costs me another $5,000 to replace the carpet, maybe it's just a large home or it's expensive carpet. I know these numbers aren't really working in reality, but it cost me $5,000 to replace the carpet. Obviously, I'm going to depreciate the new carpet, right? I might bonus depreciate it, but in reality, I'm going to capitalize and I'm going to depreciate the new carpet that the new $5,000 carpet that I went and installed. I'm going to depreciate that. But the question becomes, from this cost segregation study that I did, there was a $5,000 value allocated to the old carpet. And because I replaced it, the old carpet no longer exists, right? So if I don't go and immediately write off the remaining basis of that $5,000 carpet, and we'll talk about that in a second. We'll go into this a little bit deeper. But if I don't immediately, this is the big concept right here. So if I don't immediately write off the old carpet, the remaining value of the old carpet that no longer exists because I've replaced it with new carpet that costs $5,000. If I don't write off that old cost, now I'm depreciating $10,000 of carpet. You follow? So I buy a property, I do a cost segregation study. The cost segregation study says $5,000 is allocated to the current carpet in the current building. I buy new carpet, $5,000 of new carpet. I put that new carpet into the property. I replace the old carpet. And if I don't take any other action, now I'm depreciating $10,000 of carpet on my tax return because I never did the partial asset disposition. I never took the $5,000 of the old carpet and ripped the carpet that I ripped out. I didn't write it all off. So a partial asset disposition allows you to immediately expense the remaining value of any component that no longer exists in your property. So when I rip out the old roof, windows, doors, cabinets, appliances, whatever it is, when I rip it out, if I have a value, typically from a cost segregation study, if I have a value for that component, I can immediately write it off. Now, a lot of people think about cost segregation studies as like helping me get bonus depreciation. And if you're watching this and you don't know what a cost segregation study is, here's the 10-second explanation. So when I buy a property for $100,000, I have to depreciate that property, right? But I can't depreciate land. So I've got to subtract out the cost of land. Maybe that's $15K. So I've got $85,000 of building value, $15,000 of land value. I depreciate the $85,000 over 27 and a half years. But all the components that make up the building that are within that building are not going to last 27 and a half years. So a cost segregation study is the practice of saying, let's take that $85,000 and let's allocate it to 5, 7, and 15-year property, as well as 27 and a half year property. So we're going to depreciate it over 5, 7, and 15 years and 27 and a half years. And you're going to have like values in different buckets there. And then bonus depreciation allows me to 100% expense any component with a useful life of less than 20 years. So when I do a cost segregation study, I get to immediately expense the value allocated to 5, 7, and 15-year property. That's what a cost segregation study does. But people often forget that when you get that cost segregation study, it's identifying all the components within the property, right? It's identifying your roof, your HVAC, your water heater, your windows, your doors, all those components. Those are still depreciated over 27 and a half years. There's no bonus depreciation for those. But if you get a cost segregation study done and then you have to replace those components later, now you've got the value for those components. And now you can write that value off with a partial asset disposition. Make sense? All right, well, let's talk about an example then. So let's say that my voice just squeaked there. How's your bourbon going?
My bourbon is going. It's going all right.
Time out.
Take time out. Partial asset dispositions are an exciting topic.
It's an extremely exciting topic. It really is, though. It's like the number one tax deduction that real estate investors make. And if you get this and you can remember this whenever you do rehabs, all you have to do is just remember the term partial asset disposition. But anytime that you do a rehab, just ask your CPA, can I do a partial asset disposition? That will save you tens of thousands of dollars over the hold period. I promise you. It's more valuable than real estate professional status.
It's underrated. It's underrated. It's underrated, right?
Yeah. More valuable, right? You would agree, more valuable than real estate professional status?
I mean, I think in some cases, and in some cases, I think the real estate professional status is overrated in some cases, and I would have to agree with you. It is more powerful than the real estate professional status in some cases, for sure.
So we might have some skeptics, though, right? Like wait a second. I've been told real estate professional status is the apex of everything, and it is. It's certainly amazing. But real estate professional status, you're relying on bonus depreciation to create tax losses, right? And then those tax losses you can take against your W-2 income. And I mean, if you're a real estate professional, you can take against your W-2 income, business income, other type of income. But what happens when you sell the property?
You have to recapture all that depreciation you took.
Got to recapture the depreciation. So it's an arbitrage play, right? I'm going to get tax savings today, and then I'm going to pay it back at some later point when I have to, sell the property and recapture that depreciation. And you should arbitrage it. I mean, some people like they come and they're like, well, I just want to spread it out over 27 and a half years. No, you don't. You don't want to do that. No, you don't. Why don't you want to do that, Tom? You like talking about this.
I love that would have been a topic I would have discussed today if nothing else came up. It's the time value of money and inflation and all of that stuff. But anyway, let's keep it to the time value of money, right? Time value of money simply says that $1 today is worth more than $1 tomorrow. The reason $1 today is worth more than $1 tomorrow is several reasons. Well, inflation is going to eat away at your money. I can guarantee you that it's going to eat away at your money. So that's the first thing. Second thing
how would
is,
you explain? How would you explain that though? Really
okay.
simply.
All right.
Like
Okay.
the inflation piece.
Okay, inflation, right? So if you take 3% inflation, right, that's the standard. But so that means that if you have $500,000 today in cash, then next year it's only be worth $97,000. I'm only gonna have the same buying power as $97,000 because inflation is going to eat away at my buying power. So that's inflation. So if you just sit on your money, if you just sit on cash, inflation will slowly, year over year, just eat away at the buying power you have of the dollar. And so that's inflation. Now, the time value of money takes into account inflation. The time value of money is basically saying, okay, if you have $1 today, you can theoretically invest that money and have a return on your investment today, right? Rather, if I have a choice to receive $1 today, or say $100,000 today, or $100,000 5 years from now, that $100,000 is worth more to me today because I can take that money and invest it over a 5-year period and earn a return on investment. And I think the calculation I always go to, so the one I memorized off the top of my head, if you have $100,000, you invested in an 8% return compounded annually for 10 years, you're going to have $215,000. So let's just say that you had $100,000 that you had to pay the government today. So you wrote them a check. That $100,000, poof, gone out of your bank account, and now the IRS has it, and they're going to do what they will with it. Instead, you use one of these strategies we're talking about, the real estate professional status, partial asset dispositions. Although I got to admit, to have $100,000 in tax savings from a partial asset disposition, it's got to be a pretty sizable asset. But let's just assume you have $100,000 tax savings from a partial asset disposition, and you invest that money today. You can have a return on your investment. So basically, you could earn more money than you would have had if you paid the government. This is basically the bottom line. The bottom line is you have more money to invest, you can earn a return on your investment, and you can grow your wealth much faster through not paying the government taxes.
Yeah,
for lack of a better term. To put it very bluntly,
Yeah. I mean, you nailed it. You nailed it, right? So you want to take the tax losses today. So being a real estate professional, good, but you got to recapture that depreciation at some point. So you got to pay it all back. And now Tom just did a good job explaining why you should take those tax losses, but you still got to pay them back. But with a partial asset disposition, guess what? When you write the asset off, you don't have to pay it back because it's gone. It's no longer on your books, right? There's no depreciation recapture because it's gone. The value is zero.
It off today.
Yeah, you're writing it off today. That is why it's more powerful than real estate professional status over time. Real estate professional status, day one for sure. But give me 10 years, partial asset disposition all day long. All day long.
100%. I think a lot of people, if you can't qualify as a real estate professional, it's not always lost. I think you have to look at the vehicle of real estate and the power it has to build your wealth overall, including these little known tax benefits like the partial asset disposition, like the exit strategies you can employ to trade out of assets and have little tax friction, as if you will, a little tax drag from depleting your returns. I mean, I think in some cases the real estate professional status, while very powerful, and if you can get it, is awesome. I think a lot of people overlook these other aspects and put the real estate professional status on a pedestal, which may not always be well deserved, which is deserved, but not always the end all be all, for sure.
Right. Definitely good. Definitely a solid strategy. But there are other strategies out there as well. So we'll leave you with an example. Another example. All right, we're gonna do this all together. I buy a property. $300,000 property. I allocate 10% to land. So $270,000 is my building value. $30,000 is my land value. I had to pause there for a second. The bourbon's kind of slowing me down.
Okay.
$270,000. This is taxes in bourbon, folks. So, again, throw in the chat. What's your favorite bourbon? Where you listening from? We'd love to hear it. All right. $270K building value, $30,000 of land value. I do a cost segregation study. I take the $270,000 and I spread it out between 5, 7, 15 and 27 and a half year property. In my 27 and a half year property listing, the cost segregation lists all the different components in that value bucket, whatever. Well, let's say that there's $200,000 of value that was allocated to 27 and a half year property. $70,000 of value from the cost seg study was allocated to 5, 7, and 15 year property. Okay. So now I have $70,000 of 5, 7, 15 year property. I have $200,000 of 27 and a half year property, and I have $30,000 of land. Now I look in the 27 and a half year property, the 200K there. I'm going to look at that. And I look at all the assets that are listed there. And one of the assets is my roof. And the value assigned to my roof of that 200K, let's call it $10,000. So $10,000, that's going to be depreciated over 27 and a half years. If you divide 10,000 by 27 and a half, you get $363 every single year. That's the depreciation they get to claim every single year. Now, let's say 2 years go by and my roof falls apart for whatever reason. Something happens and I have to replace it. Now, since 2 years have gone by, I have used $727 of depreciation. So now my $10,000 roof has a $9,273 adjusted basis, basically remaining value. $9,273. We started with $10,000. We depreciated that. You depreciate $10,000 by 27 and a half years. That gives you annual depreciation of $363. But we depreciated it for 2 total years. So I've got $727 of total depreciation, which means that my basis, my adjusted basis of the roof is $9,273, right? $10,000 minus the depreciation of 2 years, $9,273. Now, let's say that, because we're in COVID world and the value, the price of everything, cost of everything has gone up dramatically. Let's say that to replace the roof, it now costs me $15,000. I tear the old roof off. I put the new roof on. $15,000 out of my pocket. No insurance, nothing. Just straight up cash, $15,000. I don't have a good accountant, and I'm also not aware of these rules. So what I do is I pull up my tax returns. I'm doing it on TurboTax, or maybe my accountant's doing it on whatever software. Doesn't matter. They're just not aware of the rules. And what happens is they just add it. They add $15,000 roof over 27 and a half years to my depreciation schedule attached to my tax returns. They just add it, and they take no other action, or you add it because you're self-preparing and you take no other action. Cool. Well, now, if that's the case, we are now depreciating $24,273 worth of roof because we did not write off the remaining value of $9,273 of the old roof that fell apart that we no longer have. So we just added the new roof, the new $15,000 roof. We just added it. And because we took no other action, now we're actually depreciating $24,000 worth of roof, even though we only have a $15,000 roof. We're effectively depreciating 2 roofs. We have a real life example of this, of a client that they bought a property. I think it was in like 90s, the early mid 90s, something like that. The original roof came with it. Then they added a new roof, or like they did a big repair to it that had to be capitalized. and that was mid 2000s. Then they added another roof in like 2010, and then another roof in 2016. And I think there was just like big repairs, too much to just immediately expense. But they're like basically depreciating 4 roofs, even though they only have one. And that's kind of what I'm trying to point out here in this example. You have a $15,000 roof that you just put on the property, but you only have one roof, and the one roof is worth $15,000. So if I pull your depreciation schedule up on your tax returns and I see $24,000 of roof being replaced, I'm gonna be like, dude, what are you doing? You have 2 roofs? No, come on. And that logic is exactly why the partial asset disposition rules exist. So that logic allows you to write off the roof that is no longer there, that you ripped off the property. So when I do this, I would report a $9,273 like loss essentially on my tax returns. And I'm not going to get into how you do that, but you just reported $9,273 loss because that was what your old roof was valued at with that cost segregation study. And it's no longer there. So you should no longer be depreciating it. And what else is cool is now I don't have to recapture that original roof that was valued at $10,000. I don't have to recapture it ever because I wrote it off. It's gone.
It's off I was gonna say it's off the balance sheet, but it's off the depreciation schedule.
It's off the balance. I mean, it's all the same thing, right? But like think about that. All the rehabs that you're doing, right? Over whatever hold period, it's really incredible. Especially if you get into like the bigger multifamily projects, that's where it gets really powerful. But hey, small landlords can do it too. Single family homes. I do it on mine. It's a really powerful strategy. Really powerful. So all you need to do is just remember, if I'm doing any sort of big rehab, I just have to ask my accountant about partial asset dispositions. Hopefully they'll be able to take it from there. And please do ask your accountant, right? I mean, I think that we're pretty damn good at what we do, but we make mistakes. Everybody makes mistakes. So I ask you to take some accountability and remember this term, partial asset dispositions, and ask your accountant about it whenever you do rehab. Now, there are anti-abuse rules, so it's not as simple as we just explained it here. But your accountant will know how to weed through that, hopefully.
Yeah, that's what you're relying on your accountant for. You're delegating that part of it to them.
Right. Allow your accountant to keep you in compliance, right? You can come to them with these types of reminders and ideas, but rely on them to cross the T's, dot the I's, keep you in compliance. Because this stuff is, I would not do a partial asset disposition on TurboTax and H&R Block. You will get yourself into trouble. Yeah.
We do have some questions about cost segregation studies and what have you. So one of the questions we have is, does a partial asset disposition make sense for a property under 200K? And what would a study cost? So a study is going to vary depending on which provider you go with. But does partial asset dispositions make sense on a property that costs under 200K? Could very well make sense. You're going to have to determine that with your accountant in terms of what the scope of the renovations you're doing. If you're going to be disposing of substantial parts of that property, then absolutely a cost segregation could make sense for you. It's just going to depend. And you could actually have a cost segregation study ran on a property of $200,000 or less. So it's very facts and circumstances based. Do you always need a cost segregation study to do a partial asset disposition? It's a very tough word to pronounce. And the answer to that question is no, you don't. There's actually another way to do it. You can use the PPI index, the producer's price index, and kind of do a calculation to figure out the cost of the roof when you put it on originally. It's a calculation that gets involved. But the bottom line answer to that question is no, you don't need a cost segregation study. It's by far the easiest way to do it. But it's not the only way to do it. So,
hey, where are you seeing the comments?
Oh, you don't see it? Restream is awesome, by the way. Anybody out there? So Restream has all the comments from Facebook, YouTube, everything on the right-hand side of my screen right now.
What? I don't have them.
You want me to share my screen? I can show you it.
No. It just says chat. Are you on chat?
On
the right-hand side?
No, I just have I have nothing. It just says on the right hand side just has a bunch of messages. Hold on. I'll take a screenshot and send it over to you.
Yeah. Please do. What? Well, I'm glad that you get to see it.
Yeah, I was just like, that's interesting. I thought that's an awesome feature because you have everything. It's Facebook, YouTube, everything
Yeah,
funnels
it's
right
supposed to be.
into.
It's supposed to be. All right. Sorry. Continue. What are some of the other comments and questions?
Um, the other comments are just where people are watching from. We got someone watching from Houston. We got someone from St. Pete, Florida. Looks like they're out in the Tampa area, which is fantastic. Love Florida, love Texas. You want to know why? They have no state taxes, unlike New York.
There you go. Oh yeah, man. Look at that. You got something nice going on there. I must be in something. I don't know what I'm doing. Enter full screen. Exit. Huh. Oh, you can at least go to the live instances. Anyway. Yeah, well, new software. We're learning. Pretty cool
We're
software.
getting better week by week, but week by week it's getting a little bit better.
Day by day, week by week. Yeah. Did you crush your bourbon yet?
Yeah, it's done. It's done. I got just the ice. So I got the little ice cubes. I got these little round ice cubes.
Oh
That's all that's
man.
left.
I'm sipping slowly tonight. I'm actually recovering from a stomach bug, so I don't know how much I'm gonna get through this, but I couldn't not do the bourbon,
Yeah, I
Otherwise,
thought
really
about it.
taxes.
It was the only time I drink bourbon. I mean, look, I have these bottles in my room my what do you call it? The dining room. Okay, the dining room is since my birthday, which was 6 months ago, and I have not touched them since. So this is actually helping me drink that out.
Get through them. Good.
Yeah.
Good. Glad we can contribute to a bad habit. All right. Well, that's it for tonight. Partial asset dispositions. Hey, for all the YouTube watchers, all the Instagram watchers, come join us on Facebook. We have a group called Tax Smart Real Estate Investors. You can find it at facebook.com/groups/Tax Smart Investors. So go check us out there. We've got 4,000 investors in there. It's a lot of fun answering a bunch of questions. And now that we're out of tax season, get to do a lot more. And also, if you are in the Facebook group, and really anybody else that's watching, but if you're in the Facebook group, you already kind of know that this is about to drop. We do have the landing page available for the upcoming Tax Smart Boot Camp. You can find that at courses.taxsmartinvestors.com. So if you go to courses.taxsmartinvestors.com, you can see the boot camp and just see information about it and purchase it. We are charging $997 for the boot camp. It's a 4-week boot camp, probably about 7 or so hours of pre-recorded video content from me, and then also a weekly live Q&A with me. We are holding the weekly live Q&As every Thursday at 7 p.m. Eastern, and they will be recorded if you cannot join. If you buy a seat to the boot camp, you will be able to jump into our Mighty Networks group, which is just a private group for everybody that's going through the boot camp. So we kind of like network and meet each other and that type of thing. But yeah, we are starting on October 25th. And if you register before then or now, you'll be able to get some early access to the content. We're going to drop it this upcoming Saturday. We're hitting real estate professional status week number 1, short-term rentals week number 2, repairs versus improvements week number 3, and then the Biden tax plan week number 4. If the Biden tax plan is not yet done or available or finalized, we will sub out the Biden tax plan with some other awesome content. But thank you so much for watching today. Really appreciate it. Join the Facebook group. We're having a lot of fun in there, answering a bunch of questions. And with that, I leave you. Good night.
Have a good one, everybody.